This video is not financial advice. Do your own research. Never risk money you cannot afford to lose. People keep asking the same question. Is the Fed about to print money? Some say yes, some say no. The truth is more precise. Printing money can mean different things. Sometimes it means the Fed is growing its balance sheet. Sometimes it means the Fed is just calming funding markets for a short time. Those are not the same. Today, I will explain, in simple language, what printing money really means, when the Fed actually adds liquidity, when it does not, and how you can read 5 clear signals each week to know what is happening. No drama, no hype, just mechanics. First, let's define terms. There are 2 big ideas, QE and QT. QE, or quantitative easing, means the Fed expands its balance sheet. It buys assets like Treasury bonds or mortgage bonds. When the Fed buys, it pays by creating bank reserves. More reserves in the banking system usually mean easier money conditions. People call this printing money, even though no paper is printed. The key point is, the Fed's balance sheet grows and bank reserves rise. QT, or quantitative tightening, is the opposite. The Fed shrinks its balance sheet. It lets bonds mature and does not replace them, or it sells assets. When that happens, bank reserves can fall. Money conditions feel tighter. Now, there's a third category, temporary liquidity. This includes things like repos, short-term loans against safe collateral, the discount window, the standing repo facility, and special programs during stress. Temporary liquidity can look like money printing because it increases reserves for a while, but it can go away fast when conditions calm down. So it's not the same as QE. Think of it as a fire hose. It's used when there is smoke, then turned off. If you remember only this, remember it well. QE, balance sheet grows. QT, balance sheet shrinks. Temporary tools, short-term support, not permanent expansion. So, when does the Fed add liquidity? The Fed has 2 main jobs, price stability, inflation, and financial stability. The system must function. If inflation is high, the Fed is cautious about adding liquidity. But if funding markets freeze or break, the Fed may use temporary tools to keep the plumbing working, even while inflation is still a concern. That's because the system must breathe. Let's talk about how you can tell what is happening without guessing. Here are 5 simple signals you can check once a week. You don't need fancy software. You just need the direction of change. Signal 1, the Fed's total balance sheet. Is it getting bigger or smaller over recent weeks? A steady rise suggests more liquidity, QE or quasi-QE dynamics. A steady fall suggests tightening, QT continues. One noisy week doesn't matter. Look for a short trend. Signal 2, bank reserves and the ON RRP facility. Bank reserves are the cash balances banks hold at the Fed. ON RRP, overnight reverse repo, is a place where money market funds can park cash. If bank reserves are rising and ON RRP is falling, money is moving into the banking system. That often feels easier for markets. If reserves are falling and RRP is rising, that can feel tighter. Signal 3, the Treasury General Account, or TGA. This is the U.S. Treasury's checking account at the Fed. When the TGA rises, the government is pulling cash out of the system, less liquidity in markets. When the TGA falls, it's often putting cash into the system, more liquidity in markets. Think of TGA like a sponge. Sometimes it soaks up water. Sometimes it squeezes water back out. Signal 4, use of repo windows and other funding facilities. If usage jumps, it can mean funding stress and the Fed acting as a safety valve. This adds temporary liquidity. It is support, not necessarily QE. If usage is quiet, funding is calmer. Signal 5, market price signals. Watch basic measures of stress. Short-term funding rates versus policy rates, the shape of repo rates, credit spreads, and broad volatility indexes. If these flash stress, spreads widen, volatility jumps. there's a higher chance the Fed uses temporary tools to keep funding smooth. If they calm down, the need for support is lower. Let's put this into a simple picture. Imagine the financial system as a set of pipes filled with water. QE turns up the main supply valve. QT turns it down. Temporary tools are hoses used to stop a fire from spreading. The TGA is a big bucket. Sometimes it stores water, sometimes it pours water back into the pipes. ON RRP is a side pool where cash can sit when it has nowhere better to go. Bank reserves are the water inside the core pipes. If you watch these flows, you can tell if the system is getting wetter or drier. Now here are a few common confusions to avoid. Confusion 1. Any facility means money printing. Not true. A repo loan that reverses next week is not the same as permanent asset purchases. Temporary support fights a short-term fire. QE rebuilds the house with more plumbing. Confusion 2. If the balance sheet composition changes, that's printing. Not always. The Fed can shift the mix, different maturities, without growing the total. What matters for net liquidity is the total size and where reserves end up. Confusion 3. Swap lines equal QE. Dollar swap lines help foreign central banks provide dollars to their banks. This reduces stress globally, but is not the same as the Fed permanently growing its own balance sheet for U.S. markets. Confusion 4. Treasury issuance doesn't matter. It does. When the Treasury sells a lot of bonds, cash moves from investors into the TGA. That can drain liquidity unless it's offset by other flows, like lower RRP or falling TGA later. So, is the Fed about to print money? To answer, don't rely on headlines. Use the 5 signals. If the balance sheet is rising, reserves are up, RRP is down, TGA is falling, facilities are active, and market stress is high, the Fed is likely adding liquidity in some form. If the balance sheet is flat or falling, reserves are down, RRP is steady or higher, TGA is rising, and facilities are quiet, the Fed is likely not adding liquidity, at least not in a lasting way. Now let's make a weekly routine you can follow in 5 minutes. Pick the same day and time each week. Then ask. 1. Is the Fed balance sheet trending up or down over the last few weeks? 2. Are bank reserves rising and ON RRP falling, or the other way around? 3. Is the TGA draining, good for market liquidity, or filling, tightening? 4. Is usage of Repo Funding Facilities up or quiet? 5. Do market stress gauges look calmer or hotter this week? If 3 or more answers say easier, liquidity is likely improving. If 3 or more say tighter, conditions are likely firming. No need to predict. Let the plumbing tell you. You might be wondering how this connects to crypto or risk assets. In general, easier liquidity helps risk assets breathe, but it's not automatic and not instant. You also need to check where the liquidity is going. Sometimes liquidity pools in the banking system, but investors stay cautious. Sometimes it reaches markets quickly. This is why we watch both plumbing data and price-based stress signals together. Also remember, the Fed tries to balance inflation versus stability. If inflation is still sticky, the Fed may avoid full QE even if it uses temporary tools during stress. If inflation cools and growth weakens, the chance of more lasting support can rise. It's a moving target. The signals help you stay honest. Let me summarize the big ideas in plain words. Printing money is a shortcut phrase. Real meaning, is the Fed expanding its balance sheet and raising bank reserves in a lasting way? If yes, that's like QE. If not, but you still see short-term lending and special facilities, that is temporary liquidity, not permanent printing. To read it, track 5 things: total balance sheet, bank reserves versus ON RRP, the TGA, facility usage, and price-based stress. Look for trends, not single-day spikes. Finally, a few calm reminders. You don't need to predict the exact day of a policy change. You don't need special access or secret sources. You just need a simple routine and the patience to watch it weekly. When several signals line up, you'll know the direction, easier or tighter. This video is not financial advice. Use common sense. Protect your capital. If the signals say tighter, be careful. If the signals say easier, you still need good risk control. Liquidity helps, but it does not replace discipline. Thanks for listening. If this simple explanation helped, consider subscribing for more clear, no-hype breakdowns of how money really moves.